Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. We love talking about US stocks, particularly because Australians can now invest in them, and we're investing in tech stocks more than anything else. They're so big, the tech companies, but they've also taken investors on a bit of a ride recently. Brent Kochuba is the founder of SpotGamma, a financial insights company based in the US, and joins me from New York, or Connecticut more specifically, I think. Brent, how are you? Welcome to Fear and Greed.
I'm doing great, thanks. How are you doing?
Very well. I want to get to specific stocks in a moment. But first, why have we seen what's gone on in the tech sector in the last few months? And in fact, there's sort of been a bit of a reversal only in the last week or two, but certainly they've been sold off.
Yeah, that's right. I think the main theme here obviously is higher interest rates, and that obviously hits the tech sector disproportionately. So we've seen a general rotation in equities to more defensive names and names that are less sensitive to interest rates. But if you look at sort of the tech sector or the QQQ ETF in general, this obviously performed quite a bit worse than the S&P. So that is the primary catalyst, we believe, for the tech weakness.
Okay, now 10 years ago, it was actually very difficult for an Australian retail investor to invest in a US tech stock. Now it's much, much easier. You can do that specifically, or you can do it through ETFs. There's plenty of options. I just wanted to run through your views on some of the big guys, and these are the ones who are, which I mean, obvious to many people, but very popular in Australia, Apple being the biggest of the lot. What's your take on Apple?
Sure. So Apple's an interesting stock here in the United States because it's almost considered something like an ETF in and of itself. I mean, it's such a large company. It's obviously one of the largest in terms of market cap. It has a tremendously solid balance sheet. And what we see from an options perspective is consistent call overwriting. So in the United States here, we get a lot of people who own Apple stock, and they'll consistently sell calls. Every month they'll roll it out to try to bring in some extra income against one of their core holdings, right?
So I was just going to say, for the mum and dad, just break that down when you're talking about call options there.
Yeah, absolutely. So one of the things that you can do, as you know, along with owning the stock of Apple or Tesla or something like that, you can obviously buy an option. You could buy a call option in general if you think the market's going to go up, or you could buy a put option if you think the market or the stock will go lower. But you can also sell those options. And so if I owned 100 shares of Apple stock, I collect the quarterly dividend, and that's great. But if I'm a retiree or just someone looking for a bit of extra income, I may think that selling calls against my stock position could bring in some money. So for example, every third Friday of the month, there's a new options expiration. So I could look out to May and say, look, I don't think Apple is really going to get up into the 200 level. So maybe I'm going to sell 200 call against the 100 shares of Apple stock that I own. And maybe I bring in an extra $100 or something for doing that.
Okay. And so that, and Apple, there's a lot of that activity around Apple?
Yeah, a lot of these core stocks that are core holdings, if you own Apple, you likely have owned it for a long time. It's one of the biggest constituents in the S&P 500. It's kind of it is the bellwether stock, I think, kind of in the world, you could argue, right? And so you'll see this in a lot of stocks that pay a good dividend. I mean, when Apple was having its surge towards last year, that yield really went down quite a bit. But you'll see a lot of this, we call it call overriding, which is the idea of bringing in income. It's quite a popular strategy here, at least in the US. And you'll see this in a lot of the stocks that pay a high dividend or pay a decent yield in general. That people will systematically sell calls, every month or every quarter, and they'll continuously just keep rolling to try to collect that extra yield.
Stay with me, Brent. We'll be back in a minute. My guest this morning is Brent Kochuba, founder of SpotGamma. Okay. Now, I hate to think that Apple is actually a boring stock, but in a sense, because it is so big, it's sort of as a bellwether, it doesn't quite enthuse people as much as something like Tesla.
Yeah.
Tesla is quite a phenomenon.
It's an amazing stock to watch. And I don't know if you all are familiar with the idea of the gamma squeeze. And it was sort of the phenomenon that broke out here in early of 2021 with GameStop and AMC. You saw just these unbelievable launch in stock prices in these names that you could argue the fundamentals didn't really support some of the price action in the stock. And the original meme stock was Tesla. And before you got the big sort of short squeeze or call gamma squeezes, or whatever you may want to call it, in AMC and GameStop, about 6 or 8 months before that, it was Tesla. And the most avid supporters of a stock I've ever come across are in Tesla. They believe that it is, the savior of all mankind. Many of them, no joking, and they have a very active options complex. And I think part of that is the reason is that it's a fairly expensive stock. It's $1,000 a share, but you can play in the options market. Obviously, the options give you a little bit of leverage. So you can spend a few $100s to buy a call option and get exposure to the upside movement in that stock. And what's interesting about that is that when traders buy call options and when they buy a lot of them, that's essentially leverage, right? When a lot of people buy calls, there are dealers or market makers that sit on the other side of those positions and they must hedge themselves. And their hedging can drive the stock price up or down. So effectively, you may spend just a few $100s on a call option and that could foist the obligation of a market maker or somebody like that to buy several $1,000s worth of Tesla shares. So it's kind of a unique situation there for Tesla. And that's why I think you get a lot more volatility there.
So there's lots of trading action on it, but fundamentally, is it a good buy or not, Tesla?
It's a very interesting stock to look at because so much of it is priced, obviously, with future expectations, right? One of the interesting things that's happened here through the pandemic is that they have somehow been able to keep producing cars and keep selling cars, I think at a rate that you could argue that some of the other key manufacturers here have been unable to do so. They've been able to open some factories quite quickly here. They just opened one down in Texas, and obviously they have the Shanghai, which is getting a lot of attention right now with the situation going on there. But they also have now the plant in Germany. And so they appear to be at this moment where they're scaling and kind of getting this critical mass together. And not only that, you have this charismatic leader in Elon Musk who, he can just will things to happen in a way that I don't think a lot of other leaders can. And I say
Tweet things to happen, Brent. Tweet things to happen, I think.
That's right. But there's a weight that comes with it, right? I think that he can compel people to do things in a way that a lot of other people can't. They have this position now that they are starting to generate income, that they maybe have finally sort of the manufacturing piece worked out, that they're building a lot of their own components and arguably they're not as dependent on a lot of other suppliers in a way that a lot of other manufacturers are dependent on different suppliers. So this could be a real turning point for the company.
Brent, what about Meta, owner of Facebook?
Yeah, and it's a challenging situation for them because there was a big change recently in the way that Apple in particular was posting or sharing data that hurt the ad pocket or hurt the ad revenue of Facebook. And they sort of pivoted here to switch into the metaverse in the United States. And I'm sure it's a similar situation there. They're caught up in a lot of issues around, what are they displaying and what are they not displaying and what's real and what's a lie. And it's just it's a jumbled sort of spider's web, so to speak, for them. And I think a lot of people are unsure of what the future of this new Meta platform is. I mean, clearly it's an issue where growth is a challenge for them. They have obviously Instagram, which is doing pretty well, but TikTok, I think, is what a lot of people seem to like these days. And so there are some, I think, growth concerns in general with Meta.
And Alphabet, owner of Google.
Alphabet is another interesting one from that ad revenue perspective and some of the things that are happening there. They're obviously going through the stock split. And what's interesting here, stock splits shouldn't change the value of a company at all, but there is this underlying idea that it makes the stock more accessible to more traders. And so that did give a quick boost to the stock. But in and amongst, it's like, as Apple is sort of a bellwether here, Google has such a solid position. They have so much information and data that they can control that it almost doesn't trade like a typical tech stock, I think, as much as some of the smaller cap or more medium cap names do.
Okay. Netflix is one that many people buy here, and I think that's primarily because we all watch it.
Yeah, and Netflix had a fairly poor earnings in January, and that really dropped the stock about 20%. And we could just see that the flows that came into the name, and this is true for Meta or Facebook as well, that for the last 2 years, we had this sort of reflexive buying, of any dip that came along. If a stock dropped at all, you would just buy the dip, right? And we would get a rally. And now what's happening is companies that don't seem to have a clear edge or a clear path forward, that reflexive buyback is not there. And you could see that in Netflix in the same way that you could see in Facebook, where if you got a 20 or 30%, drawdown again last year, that would have been bought right up, right? But in this case, where you have Netflix and Facebook, they just can't attract that same investor enthusiasm anymore, right? That buy the dip mentality is just not there in general in US stocks, but particularly in these names that it's not clear. There's a lot of competition. It's a little murkier in terms of the business environment here, interest rate environment, et cetera. They obviously have a lot of debt. And so when you add in all these factors, it's just a more challenging stock. It has a little bit less appeal. The path is a little less clear versus some of the other large cap names that are holding up pretty well.
Okay, and then finally, you mentioned the meme stocks, things like GameStop, AMC Entertainment. Where do they go?
Sure. We actually wrote a little piece on our blog about this at SpotGamma.com. And what's interesting, and I love to analyze these because if you talk about investors that are supportive of their stock, like Tesla, GameStop and AMC, there are people who are just ardent supporters and they are going to sort of stand there till the end. And what's fascinating to watch is you have GameStop, which has Ryan Cohen, who is of Chewy fame, and he's been buying shares. He just bought 100,000 shares fairly recently. And they seem to have a plan there, right? They're going to now split the stock. It's a $150 stock roughly as we're talking here. And they plan to split the stock. And they seem to be putting forward a good business plan. And by splitting the stock, again, it's going to make it accessible to more of the retail public here. And we think that unlocks a lot of the options activity in that name as well, which is an important catalyst for some of these meme names. Now, if you contrast that versus AMC, in AMC, you have the insiders who have sold, I believe, somewhere around $500 million worth of stock over the last year. AMC's CEO, they just bought a gold mine. They're big into trying to come up with NFTs and things like that. They just seem to be flailing about and not being arguably proper stewards of their investors' capital and resources. And it's a real dichotomy there, right? The GameStop management versus the AMC management. And I think that a lot of the flow after the stock split, a lot of the flow that's in AMC is going to shift over to GameStop because, again, simply as a function of share price and having a lower price makes it more accessible, makes GameStop that is more accessible to more retail traders.
Okay, Brent, here's the $64 question, and we're not a financial advice show, so listeners, go and find a financial advisor and get some help. But where are the biggest opportunities in the tech sector in the US?
Yeah, so I think you need to stick with the large companies with solid balance sheets. I mean, it's clear here that the interest rates are going to continue to go higher. And a lot of people here are concerned about some of the possible, there's some recessionary signals here in the United States. And so companies that have a lot of debt and are unable to sort of continue to finance that debt at the low levels that they've been able to for many years are going to start to have a problem. And that sort of extra capital that could just rush in and buy dips is no longer there. So we think that sticking with, the bellwethers like the Apples, and even in this case, I think Tesla's a strong stock, but sticking with those names like Google that everybody knows, the household names with strong balance sheets, they're names that everybody knows, they're well established, they don't have those same debt problems. I mean, if you look at Amazon was just able to raise a bunch of debt for very cheap for an extended period of time. And they also have a good foothold on automation and a lot of what's in the future. So these conglomerates are getting, we think, more attractive in price as the market sort of has a little bit of weakness, and they will be likely the ones that are able to function or rebound better, if there is further weakness ahead in the market in general.
Brent, thank you for talking to Fear and Greed.
Absolutely. Thank you for having me.
That was Brent Kochuba, founder of SpotGamma. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.